Alrighty, welcome everybody back to day 11 of the 30-day Traders Induction here on the channel. Today is day 11 and we are going to be dissecting the pips, points, and ticks and how that relates to the markets now trading. So, moving on, the price is represented as the number on the y-axis. So we have a price chart down here, we have time at the bottom on the x-axis, and then we have on the y-axis we have the price of the asset. So this represents the valuation of the asset in a monetary sense. Price on the y-axis, it represents the price point of an asset slash instrument, and it's measured in pips, points, or ticks depending on the asset or instrument or the market that it's involved within. It's the primary effect slash reflection of an asset's valuation. So just to take that a step further, when we're looking at a price chart, the price of the asset is the most identifiable factor, if you will, that represents the movement of the price as well as the valuation of the asset. So it's the most important thing. We're less concerned about the time, but more concerned about where the market is trading at relative to its price, where it has been in the past, where it may go in the future, and where it currently is now. It's the most important bit of information. What the pip? So pips are primarily used in Forex, and it is an acronym for percentage in point. I didn't know that until I started researching for this module, but that's what it means. I don't understand the literal translation to what that, or literal application to what that means, but percentage in point, pips are just an incremental value. So it is the smallest incremental movement of price. And now if we come down here, we've got a little example to highlight what this means as it being the smallest incremental of price. On the top right here, you've got GBP USD, which I'm looking to trade today at some point if it does shape up. And we're going to use these figures that I'm looking at in the market to highlight this example. So we're looking to short the market, so making money on its decline. We have an entry and target. The entry is at 1 spot 33,594 and the downside target at 1 spot 32,838, and I've highlighted the pip value. So as a general rule of thumb, it's the figure that's 1 over from the last, and that represents the single pip. So if we now subtract the target from the entry, because the target is less than the entry, we are left over with 0.00756, and that translated is 75.6 pips, meaning that the distance from the entry to the target is 75.6 pips. If we were to look at this from a bullish perspective, where the entry is at the bottom and we're looking for an upside target, then what we do is we take away the entry price from the target price because it's less than, and we're left this figure that we're left over, which would be the 0.0756, but in a different example, a different figure, and we translate that over in the same way to whatever pip we're talking about. So it's done in the same way, just the basic mathematics here of subtraction to leave the overhang, if you will. So 75.6 pips, and in all of these examples, the yellow figure is where the pip is placed, and this is just respective to GBP USD. So because a lot of the different markets in FX have different formatting of how they display their price points and their valuation, I've got a couple of examples. So Aussie dollar, for example, is currently trading at spot 68,410, where the single pip value is the 1. USD JPY is currently trading at 144 spot 818, where the 1 is the pip value. And the Euro US dollar is trading at 1 spot 11395, where the 9 is the single pip. Moving on to some more examples in a bit more detail, if we were to add 10 pips to the spot 68,410 of Aussie dollar, we would then have spot 68,510. So the 5 went up 1 because we're adding 10 pips, which is represented by the ones here in yellow. On the USD JPY, if we want to add 15 pips onto the market price of 144 spot 818, we're going to be trading at 144 spot 968. So we added 15 here. Okay, so we had 1 to make it go up, we had 10 to make it go from 8 to 9, and then 5 to make it go from 1 to 6. And that's how you calculate that. And then the euro US dollar, if we're adding 20 pips, we do one spot 11395, add 20 pips, and we've got one spot 11595. Now, moving on to points and ticks. Points are used with the stocks and indices primarily. That's how we define it. Like the Nasdaq's moving up 10 points, for example. It is the smallest incremental movement in price in just the same way that the pips are. And 1 point is one full unit in the value of an asset. So, for example, the Nasdaq up here trading at 20,138.47, 138. The 8 here would be the pip value, or the point value. Sorry, the point, because we're talking about an indice. And then on the stock, for example, Nike, it's trading at $88. $88.00. That final figure, that 1 cent, would be the point value in Nike as a stock. So if it's moving up a couple of cents on the day, that's a couple of points. Now, ticks are used in exactly the same way, but they're used in futures and some different commodities. So it's all the same in principle, just different naming conventions across different markets. So we've got the same example here using the entry and the target. We're looking to short the market. The Nasdaq trading at 20,138 points. We want a downside target at 20,117 points. We then do the subtraction of the lesser number from the larger number. We get the overhang of 21 points here, and that's how we can identify the movements of price. And now we're going to go from talking about how to identify the price of an asset and the points and the movements of it and how it would move, and we're going to go over into how that relates into our position sizing and risk management. So sizing up a position requires us to calculate the risk per pip, point, or tick. So for example, if we want to risk $1,000 on a position with a 10 pip stop loss, it would require a position size that equates to $100 per pip movement. So on our example from one of the previous modules, we've got our 1R multiple, or our 1R value here, which we want to equate to $1,000. We only want to lose $1,000 on the trade, which means our 1R multiple is $1,000, or 1R. Now, relative to the price chart, if we were to throw that model onto the price chart, we've got an entry at $100 and a downside target at $90. A downside stop loss at $90. We're long this market. If price gets to $90 after executing the position at $100, we want to be out. We've lost our money and we're on to the next. So what we would need to do to calculate the position size is find the calculation where each incremental pip value going from $100 to $90, for argument's sake, that's a $10 movement. We would have to calculate a position size where $1 of incremental movement would equate to $100, so that if it moves $10, we're only losing a total of $1,000. Okay? Now, different markets will have that in different ways. If you say, for example, got a 20 pip stop on FX, you only want to lose $1,000, then you need to make sure that each pip adding up to the total of the 20 pips of the stop loss in Forex would equate to the monetary figure that we wish to risk. So it's all about calculating that price per pip, or the risk per pip movement with regards to our position sizing. So I'm not going to show exactly how to calculate that. There's a few different ways. You can either do it mathematically on a calculator yourself. You can go get the position size calculators online like Stenu or MyFX book, or sometimes they have these built into the brokers when you're executing there, so it's nice and easy. So in summary, we've gone over the y-axis, which is the most important bit of information on the price chart. We've gone over pips, points, and ticks, what they are and how to identify them. And we've also gone into how the position sizing works in principle, where we're looking to calculate the risk per pip or price increment, which can tally up to and total up to our full 1R multiple. So with that being said, thank you very much for your time. Next up is day 12, where we're going to jump into the basic fundamentals. We're going to look at the economic calendars and all that kind of stuff and see how it works into the market and how we can utilize that as another not tool or way to understand where the markets may head, but in terms of when volatility may increase in the markets, and why it's important for us to be aware of what's going on from an economic standpoint, even if we're a technical trader. So thank you for your time, and I'll catch you in the next one.